Why don't we get started? It's 11:31. For those of you on the West Coast, good morning. Hopefully you have your egg sandwich and your coffee ready. And for those of you on the East Coast, hopefully you have your lunch with you and you can enjoy this presentation with an early lunch and lunch and learn. But it's great to see everyone again. Matthew, Evie here. I'm the founder CEO at First Street. And I'll run through some housekeeping items before we kick off. With me is Dr. Jeremy Porter. Jeremy, I'm sure everyone knows you, but why don't you introduce yourself to the audience?
Hey, so I'm Jeremy Porter. As Matt mentioned, I'm the head of climate implications research here at First Street, where I lead a lot of the downstream economic and social implications research. In today's report, we're really focused on one of those implications, the materiality of climate risk on actual mortgage performance.
Perfect. And so with that, a couple housekeeping items. One, you're able to put any questions you have in the chat. Fair warning, thousands of people have registered for this webinar. I'm sure there'll be hundreds and thousands that may be on the webinar right now as the numbers keep ticking up. And so we will not get to all the questions. We will try to look for trends and answer as many as we can, but please put the questions in there and we'll incorporate them throughout the presentation. I'll try and stop Jeremy and ask him relevant questions, especially if we see a lot of the trends. And there's other folks in there answering questions and helping us to monitor. The other thing is this will be recorded. That is probably the number one question we get in the chat. So you don't need to put it in there. It will be recorded. We will send it out to everyone that's registered for the webinar. And then the last thing I would say is, at First Street, we really are focused on the climate risk financial modeling category. And our team is growing, our impact is growing. For everyone in the audience, including some of our competitors, if you'd like to come work with us and work with the leader in the category, we have lots of open positions on LinkedIn. So please just go over there and check out what's available. And if you don't see something that matches your skill set, feel free to send me an email, Matthew at firststreet.org. I'd love to talk to any of you. But with that, Jeremy, I think setting the scene on why we did this report might be really important to start with. So as the standard in climate risk financial modeling, we're always working with our partners to understand what are their biggest questions. How can we help you answer those big questions with climate risk data? And the thing that always came up is, well, as a bank, as a lender, I'm not sure when we go to lend to someone, what is the impact of climate? What is the impact of these weather events, these physical climate impacts to foreclosures and delinquencies? And how do we actually know that if we made credit-informed decisions with climate data, that it would render better credit decisions overall and would make the bank more profitable? And so it was a big question because, this is a multi-year analysis that you have to do to understand what that impact is of using data like this or not using the data, the consequence of not making credit decisions with the things like actual weather events that could impact the damage, the structure, or just other things that Jeremy's going to talk about in a minute, the rising insurance premiums, which we've talked about in other national reports. So it's really with that large question that we went back to Jeremy and his team and said, how could we do this, guys? How could we actually create the data to prove the value of climate adjusted credit ratings? And this is where we came up with the 13th National Risk Assessment, climate, the 6th C of credit. So without further ado, I will pass it over to my friend, Dr. Jeremy Porter, to run through the slides and the kind of high level review of the full report that we have. The full report's on firststreet.org. If you go into our research, you can download that. And then we can also distribute these slides along with the webinar at the end if people are interested. But with that, Jeremy, take it away, my friend.
Yeah, terrific. So as Matt mentioned, we've focused a lot on direct damages, the impacts of actual exposure to climate risk, what those mean in terms of actual damages to properties, and then what those means in terms of indirect consequences, property value impacts, insurance impacts, things of that nature. So what we're really focused on in this case is understanding the materiality of climate exposure, and both direct and indirect components are integrated into this report, but we're going to focus initially on what happens to mortgage performance and the probability of foreclosure following a climate event. And so we've spent a lot of time in our own research, and a lot of folks have actually recently talking about the insurance industry and sort of some of the problems with the insurance industry, or as we referred to in one of our recent reports, the insurance issue. So one of the things that we wanted to raise was that there are structural concerns with the ways in which insurance works today. But what we wanted to do is, again, sort of reorient the conversation towards the fact that insurance is there for a purpose. It's there to protect mortgage holders and mortgage lenders, and oftentimes allows for mortgage lenders to make decisions on properties that may be in risky areas because of the risk transfer associated with insurance. So we wanted to kind of level set again, remind everybody there are two primary components associated with insurance in the mortgage market. First, there's homeowners insurance, which is required generally regardless of location. So it protects against weather hazards like wind, wildfire, and hail. And then is flood insurance, which protects against flood in particular and comes through the NFIP program from FEMA. We know there's really high coverage rates in the homeowners insurance space. We did hear some statistics following the LA fires that to some degree the increasing cost of insurance is causing more people to self-insure, but still the vast majority of properties have insurance, and in particular when you talk about the population of mortgages, you can almost assume that those properties already have homeowners insurance coverage. On the flood insurance space, there's a little bit of a different story. We know that properties are required to have flood insurance if they are within the special flood hazard area, which is FEMA's 100-year flood zone. But we also know from past reports that there are methodological issues with the ways in which FEMA creates that zone, which trickle or sort of make its way into the insurance space around floods. So those 2 points are kind of important as we set up sort of the larger structure of our report. As we always do, we lean on this billion-dollar disaster tool. It is a tool that's been really valuable to us. It gives us the ability to understand how damages have changed over time in inflation-adjusted dollars. Here we can just look at the curve. We can see that there are more damages that are occurring from climate disasters over time. We know that to some degree those are indicative of increasing frequency and increasing severity of climate risk. But we also know that there's increased asset accumulation. And in a lot of ways, what we're seeing are that, some of the areas that are most vulnerable, California, Florida, Texas, are some of the fastest growing areas that have both increasing populations, but also increasing infrastructure and increasing assets. And we're capturing a lot of that. The primary point, however, is that climate is driving up damages, and we're able to capture that directly in this chart. So as we step back from that larger context, we went to the Insurance Information Institute and looked at some of the data they had on actual payouts and changes in payouts recently. And along with the increasing damages that we saw from the NOAA billion-dollar disaster, we see that that's making its way into the insurance market as well. So you can see on this chart about the overall homeowner's average claim since about 2007 has increased by nearly 54% over that time period. But what we end up seeing disproportionately is that extreme weather events and claims associated with those extreme weather events has increased by over 117%. So we're seeing over a 2 times increase in the proportional rise in weather claims versus other claims that come along with homeowners insurance. So in a lot of ways, we saw the damages on the last slide. This is really indicative of the fact that in some ways insurance is working. We're seeing people are seeing more damages. They're making higher claims, and we're seeing those payouts associated with the claims.
Yeah, and I think it's an important point, Jeremy, that you made. And when we were presenting these slides to some of our financial institution customers, the question came up of, inflation over time or cost of materials or things in that nature. But really, it's the relationship between the two lines, right? Like that we're seeing is they're diverging. It's already bigger, and then it's continuing to increase because we're talking about the billion-dollar disaster list that you showed goes all the way back to 1980 and is continuing to go up into the right. And this is just a subset of that from 2008 going forward as well.
Yeah, and also a subset of climate hazards, weather disasters that are related to homeowners insurance specifically. So, you're talking about your wildfire, your hail, your wind events also.
Yeah. And I just for clarification, I saw a couple questions in the chat, but someone had made the question about, are you sure that homeowners insurance covers wildfire in high risk areas like California? And so I think it might be worth a couple sentences, Jeremy, on the idea of the fair plan and what that it covers and why people. But either way, you have to have it if you have a mortgage.
Yeah, and that's a really good point. Traditionally, it does. Traditionally, homeowners insurance does cover wildfire risk. We have seen in high wildfire risk areas a sort of disassociation of wildfire coverage from traditional homeowners insurance, or um, potentially something we've seen more often are non-renewals of homeowners insurance
Yeah.
policies in high wildfire risk areas. And ultimately, what you'll see then in that case is that individuals that get dropped from their private insurance covers end up moving over to what's called, in California at least, the state fair plan. And the state fair plan is there in order to provide an insurance option for people that can't get insurance in the private market. What we do see from the publicly available data from the California State Fair Plan is that insurance is often 2 to 3 times higher than what individuals are paying for on the private market. So ultimately, there's some type of coverage that's available. We're seeing an increased rate of non-renewals where people are potentially being dropped in really high risk areas, but there's some kind of coverage available. Generally, it costs more, and that makes its way into our report a little bit later today also.
Perfect.
Just building on this, we also looked at NFIP claims. So we went back, looked at claims. If you just look from 2000 to 2024, ultimately we see about a 220% increase in inflation adjusted claims amounts per claim. So along with the weather related claims that we saw on the home insurance market, if you move over into the flood space, we're seeing a relatively similar pattern. Coupling that again with the $1 billion disasters, damages are increasing, people's average claims are increasing in correlated with that increase, but that happens both in the homeowners insurance space and in the flood insurance space. And then as you start to think about these additional damages, what we're seeing are that insurance companies are raising premiums in a lot of ways. So they're paying out more for weather related disasters and claims. And ultimately, what we end up seeing is that the average proportion of the average American mortgage, as you'll see on this chart on the y-axis, is increasing in terms of the insurance component of that mortgage. So from about 2000 to about 2015, about 5 to 6% of the average American mortgage was made up of the insurance cost. The rest, again, being things like principal, interest, taxes, the other components of the average American mortgage. Since about 2017, we've seen that spike. Today, we're seeing almost a 12% proportional cost of the average American mortgage being made up of insurance. And so that means that disproportionately, interest, principal, and taxes are making up a smaller proportion, but they're not necessarily getting cheaper. They're all increasing at the same rate with inflation and with increased tax budgets in local communities. But as we're seeing is here from this chart is that insurance is outpacing those growth and taking a larger proportion of that mortgage, which means that it's making homeownership more costly and stressing household budget finances in the case where mortgages are already in place.
I think, Jeremy, this is an interesting one that where we covered this in the First Street Forecast event that we had in February when you were on stage with Dr. Carolyn Kuski and Spencer Glendon and talking about this overall around the mismatch between an annual premium, which can change in price, and a 30-year mortgage, which has certain assumptions that are going to live on throughout the term of that mortgage. And when you see a chart like this, you obviously have the instant thought of, well, clearly this is the variability between is the borrower going to be able to make the payments given the fixed cost assumptions that you have around that 30-year period. And the fact of the matter is this is a material increase in what could cause problems for a borrower.
Yeah, I think when people take out a 30-year mortgage, especially in the fixed mortgage space, they assume a certain amount of cost for a specific property. They choose that property for that purpose. If you see increases like this associated with insurance, ultimately, your fixed rate mortgage is becoming a variable rate mortgage, and it's not going to come back down. It's only increasing in terms of cost, and you may not have bought that property if you knew what the cost would have been 10, 15, 20 years out, that ultimately does end up stressing household finances and can impact mortgage performance. We talked a little bit about insurance increasing. We see how insurance is responding to the increasing damages from the NOAA billion-dollar disasters as sort of our larger frame. The other component is if we shift over to the flood space, there's a lot of uninsured flood risk. And we've been covering this since our initial flood launch back in 2020 when we first put out our national flood model. And ultimately what we find is there's about 2.2 times as many properties across the country that have a 1 in 100-year flood risk, which is equivalent to FEMA's special flood hazard area, 1 in 100-year zone. Why that's important is because FEMA special flood hazard area zone is used as a requirement or as a zone that leads to a requirement for flood insurance for mortgage properties. So if you have 2.2 times as many properties that have that risk that are in those zones, essentially half the properties that have significant flood risk should have insurance protection from the NFIP, never know they have that risk, never protect those properties, but have the same level of risk of flooding as property owners that are told they need to cover their properties. And you can see the numbers at the bottom of this slide. About 7.9 million, almost 8 million properties across the country are in FEMA's special flood hazard area zone. We find about 17.7 million properties. About 65 to 70% of that is due to the fact that heavy precipitation events aren't modeled directly in the creation of FEMA zones. Another portion of that is just due to sort of the cadence of map updates, and another portion of that is really the community buy-in and sort of the back and forth that takes place when you work with a local community, or when FEMA works with a local community to implement new flood zones. And one example of that we sort of pulled out here at the bottom of this page shows you the initial FEMA zones back in 2007 on the far left-hand panel in a neighborhood in Brooklyn, Canarsie, Brooklyn. In 2012, it was impacted directly by Hurricane Sandy. You can see the inundation layers level there. We see the area and how it was flooded. FEMA proposed a new map. FEMA came in and said, all right, we know the maps were inadequate. We can see that from the actual event that occurred. Let's come in and let's update the maps. When they updated the map, there was pushback from the community around integrating these maps with increased risk and increased insurance requirements for not only Canarsie, but many communities across Brooklyn. Ultimately, the maps through collaboration ended up looking a little bit like what we see on the far right-hand panel. But if you go in and look today at the National Flood Hazard Layer Viewer on FEMA, you'll see that the 2007 maps are actually the maps that are still in place today. So ultimately, we know there's a problem with mapping. This is just sort of illustrates the issue around the problems with getting new maps integrated, and sort of the political nature of getting those integrated with the local city. What it leads to on the larger map, you can see the darker blue colors in this case are places where we find significantly more properties at risk than what FEMA finds. You'll see trends across the country, middle of the country. These are really areas that aren't mapped very well in general. But these areas in the Appalachian region and moving up into the Midwest and Northeast are really areas where there's heavy precipitation risk that isn't mapped properly given the current mapping methodology. In places like Asheville, North Carolina pop out. I mean, that's a place where Helene came. It was an extreme precipitation event. We saw the damage and flooding that occurred from the event, and a very small proportion of properties actually had protection against that flood risk. But it really is it really does illustrate the issue.
Yeah, and I would say is that the big takeaway that everyone should grab from this is the FEMA designation drives insurance. Because it drives insurance, people that are not in the FEMA zones do not have flood insurance. That is a broad statement. It is not 100% no one has it, but it is 99% true that when people are not told that they have flood risk, they don't go out and procure a flood policy. And this is the big insurance gap that we see across the board in all of these areas. And it's also the reason why when you have major flooding events, the majority of the impacted population is not in an SFHA. And so that's happened multiple times over and over and over again. When you actually look at the destruction and the damage that happens, it happens outside the SFHA because a lot of this, as Jeremy was talking about, are major precipitation events that are what driving the claims.
Yeah, so we were in talking with people, a lot of people on this call probably, and sort of hearing about how folks are thinking about using our data in their own workflows and in their own risk analytics. Some of what we heard, especially from folks that are in the mortgage lending space, was that when they think about climate, they think about flood, 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 and part of that response was that their expectation was that wind and wildfire were covered by homeowners insurance. They're seeing on their own books, oftentimes when there's a significant flood event, that's where the losses are occurring. And then also some of the indirect impacts from rising insurance costs. So what we set out to do was set up an analytical framework which would allow us to test those things. And it starts at the very sort of top line of this chart. We created or simulated or collected data on historic climate events, wind events from NOAA's IB tracks or IB tracks. We ended up using California's DENS data, which allows us to understand the actual damages and destruction that come from a wildfire event. And then we recreated a series of historic flood events, both inland river flood events and coastal flood events, using tide gauge information, river gauge information, and precipitation estimates at the time of the event, and then plugging those into our deterministic, physically based flood model. And as you created those events, we were able to intersect the actual hazards with our properties and with the property characteristics for every single property that was in the events that we recreated, and apply our damage functions for the specific property type to that recreation. So ultimately, we were able to both recreate the event to understand exposure, but also to understand damages associated with the event. And as we had that property level data, we went back to the county level recorder data, which records transactions at the county level at the property level from county providers to understand information around the actual transactions. And the most valuable thing to us was there's a date attached to it, there's a value attached to it, but there's also a flag in that data set that says whether or not that sale or that transaction was associated with a foreclosure. So it gives us the ability then to use that information to marry it with our climate risk and climate historic observations, those resimulations, and see if in fact there is some impact from climate exposure. So we ended up ultimately comparing pre and post transactions. Our initial goal was to identify whether or not there were subgroup trends. In particular, we were focused on SFH versus non-SFHA. Ended up being a real subgroup trend that we wanted to tease out. But we were also interested in things like LMI versus non-LMI and other grouping trends that are in the report as well. So we had two main questions: are rising insurance costs and coverage gaps driving foreclosure and bank credit losses? That's what we answered directly in the analysis. The second question is, could climate adjusted credit scores help banks mitigate these losses? And ultimately, we'll talk about that at the end of this presentation. So we ended up testing about 220 or so historic events. 55 of those events ended up being a good match for the property level transaction data that we had. We had a threshold where there had to be at least one foreclosure pre-event, one foreclosure post-event, so we could make the comparison in the two areas. We also had some data from the county level recorder's office that we didn't find super reliable, so we didn't want to include any data in the analysis that wouldn't allow us to be comfortable with the results that we were producing. So ultimately, what we found was there were 55 events that gave us the ability to reliably test these relationships. And I'll jump down quickly to the wildfire and wind results. Again, remember, we were hearing from people that wildfire and wind aren't necessarily top of mind when you think about climate risk, because of the fact that homeowners insurance generally protects against these types of hazards. In the wildfire space, of the 10 wildfire events that we went back in and modeled, we actually found that 9 didn't see a spike in foreclosures, and the difference models that we ended up using to test out that relationship. One of them did, and the one that did, statistically, it was significant. substantively produced a couple more foreclosures. So even there, we weren't seeing a big spike in foreclosures from these events. On the wind side, again, more of the 16 events, 10 in fact, didn't show increases in foreclosures post event. 6 of them did. Wind, as you know, in all of these events on the wind side tend to be tropical cyclone driven, hurricane driven, so they tend to have some form of flood attached to them. So ultimately, what we ended up seeing as we separated the wind from the flood in those specific events, that there were issues in many of these cases where things like payout delays caused by sort of pushback from either the flood insurance or the homeowner's insurance on who was at fault, who needed to pay the claim, ultimately ended up helping to drive some of these foreclosures. But we're also capturing potentially community level impacts from flood. So the wind event isn't as clean as the wildfire and flood. But the flood event, on the other hand, we actually see a majority of our events do show a spike in foreclosures. So 20 of our 29 flood events showed an increase in foreclosures post event. We went back and looked at the 9 that didn't show this increase, and many of those 9 were in places that were better coverage by FEMA special flood hazard areas. So they tended to be places where we can make the same assumptions around insurance coverage that we can make around wind and wildfire in the homeowner space.
I think it's really interesting too, Jeremy, that in the wildfire case, that the actual foreclosures we did see, well, significant, but not significant in the sense of the number of them, statistically significant, but not significant in the actual losses, was actually properties that didn't burn down. It's the properties that had value depreciation from the neighborhood impacts that happened from that wildfire, which is just a really interesting thing to think about overall, is that the ones that were impacted from a credit perspective were actually intact. It's just the value of the property from the event itself.
Yeah, it's a really good point because you'll actually see this in one of our case studies. You can't disentangle the larger macroeconomic trends in an area, the ability for properties to build equity to potentially use a refinance as opposed to going towards a mortgage as a potential outcome. So there are a lot of different ways in which this could manifest itself. And in places like California, we know there's been property value growth, and there are opportunities in some cases for refinancing, loan modifications, those types of things, as opposed to moving all the way through to foreclosure. So we walk through an example. In the report, we have a handful of examples. We focused on flood because flood is where we're seeing that relationship. In the report, you'll see that we actually have hurricanes and inland events to sort of highlight the differences between SFHA coverage and the difference between coastal flooding from coastal storm surge and precipitation and riverine flooding. In Sandy, you can see all the properties that were part of our analysis. So this sort of blue outline zone that's kind of in the background is covered by the gray property dots here, but that's our area of interest for the analysis. So we did this for the 55 different events. We created this area of interest in terms of understanding how the climate event, or what area the climate event impacted. And then for every one of those, you can see these gray dots that fill this area. Those are all the properties that were in the area but weren't damaged. And then we have all these red dots, and those red dots are the properties that were damaged from the event per our own resimulation and the application of our damage functions.
Yeah, and I might add, just to add on to that, Jeremy, for the audience's benefit, when we look at the study, we have building data on the first floor elevation, the materials, all of those things that go into the structure itself. And then we're able to say, based on the depth of water that made it to that structure, was that structure damaged, and the extent of that damage. And we're able to do that through the fragility curves that we've created with our engineering partners at Arup. So we can say, because it's a single family home, it's built to this standard, these materials in it, this much water went inside. We know electrical was damaged. We know that the drywall was damaged, so on and so forth. And then the cost to actually replace that. So we can get level of damage, which is very important to also then look at in this application or in this study. And so
Yeah.
you'll see that in the report that we have much more data on that if you go into the details, but that's what's going on here for us to actually know the impact of this versus wildfires. What you can see is the burn perimeter, but then you have structures destroyed as a normal metrics that's reported out and we can see. So all of these different perils have different ways of getting at this data, but just relevant to understand because the kind of value differences that you can see from flooding, as you see from the gray structures that are fine, even though they were in inundated areas. So water just didn't make it into the building to damage it.
Yeah, that's a really good point. Many of these gray properties had floodwaters against the building footprint, but were built to a level that protected them from the actual flood depths. So the grays and the reds are important as we move into a slide, a couple slides down. But first, I just wanted to highlight again, Matt brought this up around the wildfire risk, that the macroeconomic environment is super important to understand. We know right before Sandy, leading out of the financial recession back in 2008, there was a decline in HPI in the New York City area and really across the country. But in the New York City area specifically, we saw a decline that led to the fact that many properties had less equity in those properties at the time of the event. We know when there's less equity in properties, there's less opportunity to refinance or modify loans or do other take other approaches to avoid foreclosures and delinquencies and defaults. So we wanted to track that. I also want to point out that all of our models model increased foreclosure in relation to the actual macroeconomic environment. So even in a place where the macroeconomic environment is increasing, ultimately what we're interested in understanding is there an increase in foreclosures relative to what would happen in that space or what was happening in that space post event, and to some degree those are declining foreclosure rates in really, really strong property markets where we just see less of a decline for properties that were impacted. So it's important to understand how those two things intersect and that we can't pull them apart. So really what we're interested in is understanding the unique impact of the event on the increased probability of foreclosure. And so this is an example, again with Sandy. Remember, we had those gray dots. They're just all the properties that were in the area that was impacted. We had the red dots. Those are the properties that were actually damaged. If we look at the foreclosure trend 3 years or 36 months before the actual event, we pick up the peak in foreclosures in the New York City area pre-event, which you can see here. We see foreclosure rates normalized leading up to Sandy. And then post Sandy, what we've done is we've run this difference in difference model, which gives us the ability to isolate the impact of the event on the actual foreclosure trends. And when we run that model, we've created this dotted line, which is what we're referring to as a BAU or business as usual post-event foreclosure rate. That represents the foreclosure rate in the New York, New Jersey, Connecticut area post-event as a reference point. All those dots that were gray, you can see there, if we go out to the 36-month point, you can see this gap between the business as usual and the not damaged post-event. There's an increase in foreclosures. And then amongst the properties that were actually damaged, there's a larger spike. And so on the y-axis, you'll look at these numbers and you'll say, well, those are really small percentages. We ended up running our foreclosure rates against all properties that were in that inundated area. We could run them against all mortgages. We could have run them against all transactions. The main takeaway from this is that if you look at all properties, we see the BAU foreclosure rate. We can see a 5 times increase in the foreclosure rate and probability for properties that were damaged versus that BAU. And the table also shows that scaffolds with the amount of damage. The more damage the property had, the more likely they were to foreclose.
Yeah. And similar, Jeremy, I think it's worth hitting on as we talked about with wildfire, the properties that we saw the foreclosures on were not the properties that were actually damaged.
Mhm.
In this case, you still see an increase among the properties that are in the area, but were not damaged. We'll talk about that in a couple slides, but it's also just worth noting that you see foreclosures go up even amongst the population that were not damaged directly from it.
Yeah. So climate risk at the property is really important, but climate risk to the community also is important in terms of understanding potential mortgage performance issues.
Yeah, it's one of the things we always tell our clients is that the property, commercial or residential, is only as valuable as the neighborhood, the city, or the county that it's a part of.
So the last thing I'll show in that Sandy example, we just going back to the last slide really quickly, we had that BAU, and then we had these deltas between the BAU and our damaged and in event probabilities. We wanted to try to quantify what were the additional foreclosures that were caused just by Hurricane Sandy, all else being equal, and what were the losses attached to that. And ultimately, what we found was there were about 393 additional foreclosures on top of what occurred in the area already, just given business as usual conditions. And the losses for that were about 68 million dollars, and that's not in property value, though. That's actually loan value that was lost. So we ended up using LTV, estimating LTV at the time of the foreclosure relative to the loan origination. So we're actually looking at losses on a property value perspective would have been much higher. In this case, we also estimated a 50% loss given default. So it also takes into account the expectation that mortgage holders would be able to recover some of the losses, but still a significant amount of hidden foreclosures, hidden foreclosure losses, that if you're thinking about a risk layering approach within a financial institution, understanding climate gives you another layer of risk to layer on top of all of the other components that are already integrated into those credit risk modeling profiles.
And it's important to note as well that we aren't able to see all of the actions that the financial institution took throughout the delinquency and all of the issues along the way, or loan adjustments, or anything that you're trying to do to not get to this outcome at the end. And so all we're able to see is the event happened, and then when does it link through to the foreclosure itself. So while there is a dollar that we can assign to just the foreclosures, the cost of all of the effort to try and go through to ensure that you limit this number to be as low as possible are all costs that we aren't able to calculate because we don't have access to that data. But you can understand that it is an order of magnitude higher than what we're actually showing here as well when you think about the capital that goes into trying to do the adjustments, the loss data there, and the actual costs of the employees doing all of that work and going back and forth.
Yeah, you're right. We're at the end of the pipeline, understanding 90-day delinquency rates, 120-day delinquency rates, prepayments, all of those indicators we didn't have access to in our data set. But you're right there. There's sort of this compounding cost to the mortgage providers in that case. So Matt mentioned earlier the impact of flooding and event exposure to the community. I think this is one of the most telling graphs that we actually produce. So these are our flood events taken in as a group as sort of a meta-analysis. And when we look at the properties that were in the special flood hazard area, we actually see a decrease in foreclosure amongst those properties. So relatively small, probably not statistically significantly different from zero, but it's still a negative trend amongst properties that were in the area. Amongst properties that were damaged, we actually saw a 10% decrease in foreclosure rates post-event, indicating that, again, insurance is working. We expect that many of these properties have insurance, that they're able to obtain their payouts, able to repair their properties. The communities have an influx of cash coming into the area where properties are being impacted, and you're not seeing those spikes in foreclosures. Where we see the activity around increased foreclosures are outside of the special flood hazard area. So these are both for non-damaged properties, there was a 10% increase, and for damaged properties, we saw about a 42% increase. Ultimately, the main takeaway for me really is that insurance protects properties, but it also protects the communities. If you're investing in a community that doesn't have good coverage of flood zones, whether you have significant risk or not, you're still likely to be impacted negatively by that climate risk. So it really is a telling graph to me that we're sort of parsing the event exposure down to flood in the first place, and then we're further parsing it down to specifically non-SFHA areas that were impacted by flood events.
Yeah. Yeah, and I think it's like visually you can just kind of picture in your mind, right? Flooding comes into a community, it destroys the community to some extent, but then the insurance money flows in, everyone starts rebuilding. You see that economic activity come back, that you're able to rebuild and get the community back on its feet, which is represented on the left side. Then on the opposite of that is no insurance. The absence of insurance means that those properties are sitting there damaged and the economic activity is not coming in to try and rebuild them. And that has a negative effect on the properties that were not damaged themselves. And so that value, that equity that's built up in the home is then diminished. And then that's where you see this impact overall to the second order impacts that Dr. Porter was just talking about.
Yeah, and this we'll move into indirect impacts after this, but this really was super interesting to be able to actually model this, to be able to actually hear from people in industry tell us we're really concerned about flood. We're not as concerned about wildfire or wind, but in the flood space, we're really concerned about the undercoverage of properties that have flood risk, and to see that play out systematically through the steps of the report and to be able to prove out that there actually is this material connection back to flood risk and the undercoverage of flood insurance was one of the main takeaways from the report for me. In terms of an indirect pathway, we created this data using zip code level insurance rate filings across the country for every zip code. All these little gray dots in the background represent a zip code across the U.S. We have insurance rate filings at the zip code level from 2019 to 2024. We took that data, created a percent change metric to understand how insurance premiums have changed in that area over that time period. And then we took the local foreclosure rates in those zip codes from those same county level recorder data and modeled the change in foreclosure rates over that time period. This is a correlation. This isn't as much of a direct impact as what we were able to model on the direct exposure, but it shows you clearly that areas that have increases in insurance premiums are also seeing increases in foreclosure change. So there is this indirect connection that can be tied back to increased risk. It can be potentially tied back to actual exposure that's occurring in an area, but it really is showing that increased cost of insurance is leading to foreclosures.
Yeah, and this kind of goes back to Jeremy because there was a bunch of questions in the chat around these insurance impacts or the macroeconomic impacts. This goes back to we were showing that chart of the insurance as relative to the mortgage payments as a percentage to show that cost of increase insurance premium that you have to have if you have that mortgage is increasing. And then this data is then saying the so what of that? What are we actually seeing? We're seeing that is then by itself, regardless of the other impacts that we were talking about on the direct side, also attributing to foreclosures through the correlation that you see in the chart.
Yeah, I keep going back to risk layering. I mean, climate is an amplification effect. I mean, people, they have their own household budgets. If a life event occurs and all of a sudden now they have these increased costs of home ownership from insurance, they're more vulnerable and they're more likely to see poor mortgage performance outcomes from that. We likewise we looked at macroeconomic change. So we modeled the change in local GDPs, change in local HPIs. We modeled them at the local market level. Ended up focusing on counties across the U.S. Ultimately, what we ended up seeing was as GDP and HPI increased, foreclosure rates decreased. I think folks would expect that to be the case. We know as GDP and HPI increase, property values increase, and as property values increase, equity increases, which reduces the likelihood of foreclosures. So again, there's that interconnection between all of these different indicators, but taken together, we have from those difference in difference models that we ran on the actual flood events, a coefficient associated with being in a flood event and being damaged and the likelihood of foreclosure. We have a coefficient associated with increasing premiums and the likelihood of foreclosure. And then we have these coefficients associated with changing macroeconomic conditions and decreases in foreclosure. When we took all of that information together, our next step in the report was to say, okay, can we take all of this information and all the work that we've done at First Street to understand and project risk in both short-term and longer-term projections and try to estimate the hidden credit losses that exist today on mortgage holders' books. And so that was the sort of the last step of our analysis was to take that information and create a predictive model to try to understand, well, can we quantify today the amount of these hidden credit losses? And so as we created them, we went back, we looked at all properties that were in our 1 in 100 year zone. We looked at the mortgages that exist today on the books as both the value of the mortgages, but also the number of properties that hold mortgages today. And we ultimately ended up applying all of those different coefficients that we observed from the historic relationships. And we found there's about $171 million in hidden credit losses today, growing to about 760 million in hidden credit losses. One of the main takeaways, though, or one of the main things to understand about that is that's not a huge number for people that are in the finance industry and in the mortgage industry, but it's what we would refer to as sort of an average expectation. So annually, this is what we would expect to exist. What we're seeing much more often are that in severe weather years, these darker colored dots are what we're actually seeing as payouts and actually seeing as damages. So any year when there is a Helene, when there is a Sandy, when there is a Katrina, when there is a Harvey or a Florence, any of these events, plus all of the unnamed inland flood events that end up damaging so many properties, what we are really seeing are mortgage losses more in line with about $1.2 billion hidden today, growing to about $5.4 billion in about 10 years. So that increased climate risk and the increased cost of insurance associated with that, and even macroeconomic trends all come together to sort of highlight the fact that we have potentially every year billions of dollars in hidden credit losses in the mortgage market.
Yeah. And this comes back to the materiality question, Jeremy. Like we did a report a while ago, portfolio pressures, where we were talking about when you're looking at the bank's portfolios, what are you seeing, and is there a material risk here? It's one thing to look at it as an average number and say, okay, well, we can withstand that in a given year because these are these are foreclosures that are happening that people are absorbing right now. It's the spike. And then where is that spike? Because if you have a concentration of mortgages in an area, that's when you end up with, oh my goodness, is this a material event that I'm going to be facing? Especially as you see these numbers grow. And so it is not that this will happen every year. It's when it does happen, that's when it punches up and you wouldn't have expected it. And you end up with these losses that are far out of line with any expectation that you would have had. And so how do you model that properly? The other thing, Jeremy, it'd be great to hit on, I think, is obviously we're not saying that flood risk is 5x over the next 10 years and that's what's driving this. It's also the insurance side that you were talking about is one of the main drivers of those increases over time and the annualized increases that we see. So you could touch on that, but before you do, the other thing that I think is really important is that you mentioned all the major events that are happening, but I think it's the thing that we also see is exactly what you had said, but worth reinforcing. The smaller flood events that impact properties are the ones that are driving a lot of these numbers. You'll see huge numbers like we went through Sandy and we showed that $60 million number. That was a massive event, but it's all that extrapolated across the country in a given year across all flooding events that happen all the time that just don't necessarily make headlines.
Yeah. Yeah, you made a really good point. I want to point out on the bottom of this graph where we got that 95th percentile metric. We pulled it from the NFIP payouts. If you go and actually look at the payouts, you will see sort of average payouts, average payouts, average payouts, and there's this big spike in payouts associated with an event that occurred. Ultimately, what we found was a 95th percentile of those payouts was about 4.8 times or so more than the average year of expected payouts. And in mild years, the fifth percentile was about 0.7 or so of the average. So our average expectation aligns much more with what we may think of as like a mild weather year, but we're seeing more and more these climate disasters that are occurring, like Helene, like Milton, like Ida. I mean, every year we can find one that we can call out. And so it's not that in an average year we wouldn't expect any of these events. We're actually expecting these events to occur more often than not. And on the projection, it's a really good point. It is sort of the accumulation of both direct and indirect impacts. The direct impacts are the expectation of flood risk and the expectation of flooding from flood risk, and they do drive a good portion of the hidden credit losses, but a big part of it is sort of that more market-driven and macroeconomic drivers that are related to the indirect impacts of climate exposure. So increasing insurance is definitely tied to that. We model that with our AAL metrics and try to understand how those average annual losses are increasing over time given exposure. But we're also modeling things indirectly like climate migration and changes in climate migration and how those impact GDP, HPI, and these other macroeconomic drivers that are likely to contribute to foreclosures, as we saw in the previous slide. So it really is the accumulation in this case of both direct and indirect drivers of mortgage performance that we're capturing with this projection. In the report, we also want to just kind of highlight, where these credit losses exist geographically. They're not evenly distributed across the country. This map, because we're presenting it in dollar form, you tend to see a lot of places that have high value properties and high levels of climate risk. Even on the West Coast, I've presented this out to a few people, and they'll ask about California. You can go back and look at California. Recently, we have the atmospheric rivers that seem to be occurring every year now. Those are 1 in 100 year or less probable events in terms of the water levels that are attached to them. So we're seeing a lot of these different events that are occurring in places that oftentimes we would look at and say, well, there's a lot of wildfire risk there, but I don't know that there's actually flood risk there. Along the Gulf Coast in Florida, sort of the Southeast Atlantic coast, we see a lot of that risk. Up into the mid-Atlantic and lower New England area, a lot of high value property in this area, but we also have seen sort of a northward and poleward movement of hurricanes and tropical cyclones in the recent past, only expected to increase as we move into the future. So there's likely to be more and more risk in those areas. And then further inland, we're seeing a lot of precipitation risk. So the way in which climate it has been manifesting itself in the Midwest and in the Northeast and the Appalachian region, parts of the South, is really through extreme precipitation events and severe convective storms. And we're seeing that in this map, where we're seeing more and more of these areas that are undermapped by FEMA but have significant heavy precipitation risk. Places like Asheville, which make their way into this map as one of the darker red colored areas. Places like Northern Ohio, Southern Michigan, places where we've seen significant flood risk in recent years from heavy precipitation events. Vermont pops out. We saw an inland flood event there not too long ago. So these are places where we're not tracking flood risk very well, but there is significant risk even in some of these places with modestly priced properties, which drive up those credit losses. And I'll turn it over to Matt to talk about the big punchline, I think, from the report.
Yeah, thank you, Jeremy. The interesting part about how credit is usually referenced are the 5 C's of credit. And so, as someone who loves marketing, when I realized and we were talking about that, and then obviously climate is another C, it just made sense that we had to name the report the 6th C of credit. But really what we're talking about today is that outside of the basics around character, capacity, capital, condition, and collateral, climate has really turned into this 6th C of credit that you need to consider. And especially on that asset side, the economic and physical impacts of it, without actually including this in the decision, then you're going to be missing a significant portion of risk in any of these credit decisions. And so how do you do that? Like, that is at the core of what First Street offers. And so with a lot of our financial institution customers, what we do is we run a playbook of how you take the property level data and how do you apply that into these decisions, and what are the things that you can do from a portfolio perspective to then understand the level of risk that may be in the current loan book, and how do you make better decisions going forward. So all of this is mapped out in a playbook that we offer to our partners, exactly how you can then add this in, add climate as the 6th C to make these better decisions and just make more efficient loans and make more of a return off of them. And I think it's really important to also note here that we are not saying that this is about the individual, because there's a lot of, from a lending perspective, concerns around the LMI population and the overall overlapping of risk, which tends to happen a lot. this is based that the climate aspect of it is about the structure. So how risky is that structure and how should that be taken into account when you're looking at the loan or the insurance that should go with it? So it is absent of the individual credit worthiness and it is more about the structure itself. And so that's how we think about this when you're looking from a lending capacity is how do you have the assessment of the structure, the actual underlying asset itself, not the borrower creditworthiness that you want to be considering when you're making these loans. And this flows through to the commercial side as well. This report was 100% focused on the residential side, but the same thing is true when you're looking at commercial lines or CNI or whatever it might be, which is all things that we help our clients with. So that's really the idea that we were trying to answer. Dr. Porter did a wonderful job with the team to really tease out the answer that was at the core of the question of are we seeing actual impact from these weather events flowing down to foreclosures, and then how can we do something about it? And so it was a great assessment, a wonderful job by the team. And Jeremy, if you go to the next slide, it's been great to be with everyone. But if you have any questions around this or how we can help you implement this, whether it's asset owners and managers or financial institutions, whatever it might be, please reach out at BD, business development at firststreet.org. You can send me an email at matthew@firststreet.org, or you can send Dr. Porter an email at jeremy@firststreet.org. We're happy to have your questions. We'd love to interact with you, and we'd love to help in any way. And as I said at the beginning, we're growing. We have lots of open positions. If you'd love to join us, we'd love to have you. You can see that on LinkedIn, or you can reach out for any of the open roles or to have a conversation with us. But thank you so much for joining, everyone. We have a recording going out. We'll send out the slides. And until our 14th National Risk Assessment, we hope everyone has a wonderful day, and we will see you at that time. Thanks again.
Thanks, everybody.